Welcome back to Wall Street Podcast. Today, we're doing a deep dive into the tech sector. We're pulling insights directly from Morgan Stanley's latest CIO survey. It's called 2Q25 CIO Survey, not completely unscathed.
Yeah.
For this report, it was fielded between May 7th and June 10th, 2025, just published July 9th. They talked to 100 CIOs in North America and Europe. So it gives us a really direct pulse on IT spending. You're here for actionable intelligence, right? Not just noise. So our mission is to unpack what these CIOs are really planning, where the money's flowing, and what it means for tech and your strategies.
Exactly. And this survey really helps illuminate those shifts. IT budget priorities, the impact of GenAI, how macro factors are shaping tech decisions. It's fascinating how these sometimes subtle changes in sentiment can signal pretty big market implications, especially for you trying to navigate this landscape.
The macro picture IT budget health check.
Okay, let's get into it. The headline number, 2025 IT budget growth, expected at 3.6% year over year. Now, 3.6% sounds sort of in line, maybe okay, but the report stresses it's a material downtick. They were thinking more like 4.1% going into 2025, so this isn't just a minor tweak. What's the real story behind this normalization at 3.6%?
Well, you're right. It is lower than those initial hopes, but the report actually calls it more constructive than feared, especially when you look back at late Q1. Remember that volatility after February 20th? The expectation dropped sharply then, down to 3.2%.
Ah, okay. So compared to that dip.
Exactly. Compared to that, 3.6% looks like a stabilization, sort of settled in this 3.6% to 3.7% range for, I think, 4 surveys now. So it indicates a stable environment. Maybe subdued, not explosive growth, but stable.
Right.
Predictable, perhaps, for investors.
Okay, stable but subdued. Now, how do we square that with the short-term versus long-term view? The report mentions a 1-year up-to-down ratio of 0.7x. That sounds like a downward bias near-term, right?
Definitely a downward revision bias. That ratio, 0.7x, it basically means more CIOs expect to cut near-term budgets than increase them. For every 10 looking up, 7 are looking down, roughly speaking.
Okay, so short-term caution. But then the 3-year ratio is a healthy 3.4x. That's a big difference. How do you explain that apparent contradiction for our listeners?
Yeah, that's a really crucial point, the near-term caution. That's the macro volatility talking. CIOs are being careful with immediate discretionary spending. It's less about a positive push, more about just avoiding budget cuts, a lack of budget degradation, as the report puts it, prudent management.
Got it.
But the long-term optimism, that 3.4x ratio, that digital transformation, cloud, AI. You see, 37% expect IT spend to grow as a share of revenue over 3 years. Only 11% expect declines. So while the immediate purse strings are tight, those strategic long-term IT investments, they're seen as absolutely essential, foundational for growth.
Makes sense. What about digging into regions or industries? The U.S. seems to be ahead of Europe.
That's right. U.S. CIOs expect plus 3.7% growth, a bit ahead of their EU counterparts at plus 3.2%. Pretty consistent trend there.
And industries. Any standouts?
Yes, definitely. Retail, energy, and manufacturing are really leading the pack. They're looking at growth around 4.2% to 4.4% for 2025. And interestingly, retail and healthcare saw the biggest acceleration compared to last year.
So what's driving that? Are they just cashing up or facing specific pressures needing tech solutions?
It could be a mix, maybe some catch-up, but also specific industry pressures. Think supply chain resilience for manufacturing, e-commerce and personalization for retail, telehealth for healthcare. These things demand digital investment.
Sector-specific spending trends and priorities.
Okay, let's break it down by IT sector. Software is still the fastest growing at that same overall 3.6% rate.
Right.
But it also saw the biggest downward revision from the last survey, down 18 basis points, so 0.18 percentage points.
Why the pullback there?
Well, this is where it gets really interesting. There's a debate highlighted in the report. Is generative AI cannibalizing traditional software spend? Eating into those existing budgets? Or is it just that these big GenAI projects haven't really moved from testing, from proof of concept or POC into full production yet? Maybe the ROI questions are still lingering?
So the pie isn't necessarily growing, it might just be shifting or waiting.
Exactly. And the answer really matters for software vendors and investors.
Okay, so if software's seeing that pressure, what about hardware? You wouldn't necessarily expect strength there.
Surprisingly, yeah. Hardware was the only sector with positive revisions sequentially. It was modest, just 8 basis points, bringing its 2025 growth forecast to plus 1.5%.
Still the weakest overall growth, but positive revision is noteworthy. What could that mean? Foundational spending.
That seems to be the thinking. The report mentions things like SMB green shoots, so smaller businesses might be investing. And importantly, it notes AI is not seen as cannibalizing traditional hardware spend. With, what was it, 66% of AI projects expected to hit production this year or later? Well, you need the hardware for that, right? Servers, maybe specialized chips. So it could be that foundational investment starting.
Interesting. Okay, let's shift to priorities. What are CIOs saying is most important for spending increases in 2025?
No surprise at number one, artificial intelligence machine learning, AML. It holds that top spot. Following that are cloud computing and security software.
But there was some movement within those top three.
A little bit, yeah. AML and security saw a sort of modest moderation in how strongly they were prioritized compared to the last survey. But cloud computing actually saw the biggest increase in prioritization, up 230 basis points quarter over quarter.
Wow, so cloud's getting even more focus. Why now?
Well, it likely ties back to AI. Cloud infrastructure often underpins those AI initiatives. You need that scalable platform. But here's something else that stands out. Defensibility.
Meaning, what's least likely to get cut if budgets tighten?
Exactly. And security software wins there by a mile. It's seen as the most defensible IT project, driven by, the growing attack surface, more severe threats, regulations. And interestingly, GenAI itself is seen as expanding that attack surface, more complexity, more risk.
So security becomes even more crucial. What about AML's defensibility? It's the top priority, but is it safe from cuts?
Less so, apparently. AML process automation actually screened as relatively less defensible this quarter. It ticked down significantly, about 800 basis points. So top priority for growth, yes, but maybe more vulnerable in a downturn compared to security.
And some things are clearly lower on the defensibility scale.
Oh, yeah. The report explicitly calls out things like strategy consulting and social software as being more nice to have relative to need to have.
The generative AI impact funding, deployment, and winners.
Okay, let's really drill into GenAI. The funding is key. Where is the money coming from for these AI projects? Is it new money?
Increasingly, yes. The survey found 39% of CIOs are using net new IT budget dollars for AI. That's a pretty notable jump from 29% just a year ago. In 2Q24, it suggests the value proposition is becoming clearer.
So almost 40% is new money. What about the rest? Where are they reallocating from? What gets cut to fund AI?
The report points to a few areas taking the hit. Things like traditional data warehousing, business intelligence and analytics, DWBI analytics, also desktop virtualization and business process outsourcing, BPO. So you see a clear shift away from some older tech and outsourcing towards AI investment.
And the timeline for these AI projects actually going live, is it accelerating?
It seems steady. 60% of CIOs expect to have GenAI workloads in production by the end of 2025. That's basically unchanged from the last survey. About 27% say they already have them in production now. So steady progress from POC to actual deployment, but maybe not a dramatic speed up.
What are they trying to achieve with these AI initiatives? What are the main business goals?
The top objectives mentioned are things like internal employee productivity. Think tools like Microsoft Copilot, also worker labor savings, and customer-facing applications. So efficiency and customer experience are key drivers.
And where is GenAI being used most today?
Right now, IT operations leads the pack in terms of deployment, followed by marketing, HR payroll, and corporate finance strategy. Where they're seeing the initial cost savings seems to be in areas like supply chain and inventory management, also sales and general corporate functions, all showing about a 2.5% reduction.
Interesting. And some areas still need to prove the ROI.
Yeah. Areas like legal, risk, compliance, and customer service are noted as having more to prove out from an ROI perspective. The value isn't as immediately clear there yet.
Okay, let's talk vendors. Who did the CIOs see as the big winners in this GenAI race?
Well, it's hard to ignore Microsoft. They clearly maintain a leadership position. CIOs expect Microsoft to capture the largest share of incremental GenAI spending in 2025. About 25% of CIOs pick them by a wide margin.
And that holds for the longer term, too.
Yes, that leadership view extends out 3 years, according to the survey. We also see really high expectations for Microsoft 365 Copilot adoption. 72% plan to adopt it in the next 12 months.
72%. That's huge.
It is, and they expect deployment to ramp up too, from about 31% of employees using it in the next year to 43% over 3 years. Microsoft's also seen, alongside Amazon, as a top vendor for developing those AI agent strategies.
So for investors, Microsoft's position looks strong, but it hinges on delivering that value, right, to justify the premium.
Absolutely. The adoption numbers are high, but proving sustained ROI will be critical.
Cloud migration and enterprise software shifts.
All right, let's pivot back to the cloud. The shift continues, right? Where do workloads stand now?
They do. CIOs estimate about 44% of application workloads are in the public cloud today. That's up from 40% last year. And they expect that number to hit 68% by the end of 2027.
So still a strong trajectory, even if the pace is maybe moderated slightly from those huge jumps we saw earlier?
Exactly. It's still tracking well ahead of historical trends. It's a persistent, fundamental shift.
And the big players remain the same.
Pretty much. Microsoft Azure and Amazon AWS are still the dominant providers. The survey suggests Azure is expected to gain the most share over the next 3 years.
And who's feeling the pressure from this shift?
The report specifically highlights Dell, VMware, and Oracle as facing the highest risks of losing budget share because of the move to cloud. It underscores that ongoing re-architecture of enterprise IT.
Okay, let's talk software as a service, SaaS. Spending growth there is expected to pick up a bit.
Yes, expected to accelerate to plus 5.5% growth in 2025, up from 4.7% in 2024.
Still below the older highs of 6-7%, but an acceleration nonetheless. Where's that SaaS money going?
Top of the list is business intelligence and analytics. That is a 57% net score for increased spending, followed by things like collaboration, content workflow management, and ERP.
Any areas looking weaker?
Marketing SaaS seems to be a more challenged area of the budget, according to the report. It really highlights that focus on data, analytics, operational efficiency. That's where CIOs see the immediate SaaS value right now.
We also saw something interesting about front office versus back office applications. Front office is leading for the first time in a while.
That's right. Front office apps showing plus 4.7% growth compared to back office at plus 3.9%. It's the first time in about 4 years front office has been ahead.
What could that signal? A shift in focus towards the customer again?
It might mean we're past the digestion period for some of that front office spending bubble we saw previously. Plus, with potential easing of cyclical headwinds and GenAI goals often targeting customer-facing applications, it could provide some relief for those front office software segments, a renewed focus on customer interaction, sales.
Okay, one more area. ERP, enterprise resource planning. Sounds like a big upgrade cycle is coming.
A pretty significant one. 40% of CIOs expect an ERP upgrade within the next 2 years.
What's driving that? Just old systems needing replacement?
Partly that, yes. Things like end-of-line deadlines from on-premises vendors. But also, crucially, the need for a modern architecture to start leveraging AI tools. You need that foundation.
Makes sense. Are upgrades taking longer now with cloud systems?
Slightly. The average cycle length edged up to 6.1 years. Maybe because cloud systems need less frequent major overhauls. But in terms of vendors for cloud ERP, Workday has actually risen to the top preferred spot in this survey, followed by SAP S/4HANA and Oracle Fusion.
And what parts of ERP are they prioritizing first?
Procurement and planning modules seem to be the highest priority for those initial purchases. And interestingly, they expect to use third-party best-of-breed vendors for those specific functions, not necessarily the core ERP provider.
IT services navigating headwinds.
All right, let's move on to IT services. Growth expectations there seem to be slowing down a bit.
Just slightly. A slight sequential deceleration to plus 2.5% growth expected for 2025. Still a touch higher than 2024, but a slowdown.
How's the environment for service providers? Are talent shortages still a big issue? What about pricing?
Well, the good news for CIOs, maybe less so for providers, is that talent shortages seem to be easing. There was a big drop in reported lead times, 47% now, versus 68% back in 4Q24.
So, easier to get project staffed, but pricing.
Pricing looks softer. Discounting is reportedly more prevalent across basically all the vendors surveyed. The report even names a few like HCL Tech, Cognizant, Wipro, Accenture as showing a greater willingness to discount. So definitely a more competitive, tougher pricing environment, likely due to the macro uncertainty.
And are companies still looking to consolidate their service vendors? Using fewer partners?
Oh, absolutely. That trend continues. 56% of CIOs said they are undertaking vendor consolidation.
Who's benefiting from that consolidation?
On a net basis, TCS and Deloitte screen as the biggest beneficiaries gaining share. While Infosys and the smaller other providers seem to be losing out the most, it's that flight to scale, looking for integrated offerings from fewer, larger partners.
Within IT services, where are the spending priorities?
Application development and consulting and systems integration are leading. Both are expected to see the biggest spending increases over the next 12 months.
Driven by?
Likely driven by all the things we've discussed. Software upgrades, cloud projects, and definitely that increasing interest in generative AI, even if it's just for proof of concept work right now. That often requires external help. Also, interestingly, 57% expect their digital transformation efforts to actually increase spend on traditional IT outsourcing too.
And finally, the specific initiatives driving services demand in 2025.
Top three IT services initiatives are security cyber, artificial intelligence, and software upgrades. And for all three, CIOs showed high intent to use external service providers. It just reinforces how strategic these areas are. Even if overall budgets aren't booming, they need external expertise here.
Deep comments and Q&A.
Okay, we've covered a lot of ground. Budgets, AI, cloud, specific sectors. Now let's try to tie it all together in this final segment. We've pulled out three key questions that really get to the heart of what this survey means for you.
Sounds good. Let's tackle the first one. Q1. We see these mixed signals, right? Overall, IT budget growth is kind of range-bound, not really taking off. But AI is the top priority, and it's getting net new funding. So what does this really imply about the broader market's ability to make money from AI? Beyond just the obvious big winners, yeah, that's a critical tension. You've got strong AI focus, new money flowing in, but the overall IT budget pie isn't really growing significantly, and neither is broader software spending. What does that suggest? Well, maybe AI is cannibalizing some traditional spend elsewhere. Or, like we discussed, maybe a lot of it is still stuck in that POC testing phase. It's not yet translating into those huge, widespread production deployments that would lift the entire IT budget boat. The report is pretty explicit. The range of AI winners likely remains narrow, as long as the ROI isn't clearly proven for broader applications. So the gains stay concentrated with a few key players, like Microsoft for now. For the rest of the market, they need to show concrete, scalable ROI from GenAI before you see a big, widespread boost to spending. The pie isn't getting bigger for everyone yet.
That's a really important distinction. Okay, second question, Q2. The survey shows that short-term downward bias for budgets, the 0.7x ratio, but clear long-term optimism with the 3.4x ratio. How should you interpret this apparent contradiction, especially when you throw in weird signals like that small positive revision in hardware?
Right. How do you navigate that as an investor? The short-term caution, that 0.7x ratio, that's clearly a reaction to macro picture. Uncertainty lingers. Companies are being careful, prudent with immediate spending. Risk off, maybe. But the strong three-year view, the 3.4x, that shows they haven't lost faith in the big picture. Digital transformation, cloud, AI, they know these are essential long-term. It's like they're playing defense short-term, but planning offense long-term.
And the hardware uptick.
That little positive hardware revision, even though it's the weakest sector overall, is intriguing. It could signal that foundational reinvestment. Maybe it's the infrastructure needed to eventually move those AI projects from POC to production, or maybe specific demand from SMBs. It suggests that even while CIOs tighten their belts now, they know they have to invest in the core tech foundations for the future. So certain hardware plays might be more resilient than the overall sluggish trend suggests.
Okay, makes sense. Final deep comment, Q3. Microsoft's dominance in GenAI seems clear from the survey. High Copilot adoption expected, strong share gains. But does the survey hint at any risks or challenges for Microsoft in actually monetizing GenAI and sustaining that lead going forward?
Yes, even for Microsoft, there are nuances. While the leadership is clear, the survey does show a notable moderation in the expected usage of things like Microsoft 365 Copilot and Azure OpenAI services when you compare the next 12 months view to the next 3 years view. For M365 Copilot, for instance, planned adoption drops from that high 72% in the next year down to 43% when looking out 3 years.
A drop-off. What does the report say about that?
It suggests this underscores ongoing need for the company to prove out the ROI of the solution to drive durable adoption. It even hints it could be potentially indicating signs of dissatisfaction. Similarly, Azure OpenAI adoption expectations also moderate over the longer term, possibly due to increased competition. So what's the takeaway? Even for a leader like Microsoft, the big challenge is converting that initial hype and high adoption into sustained, broad, high ROI usage that drives ongoing revenue. It's about moving beyond initial licensing. The honeymoon might be ending, leading to more scrutiny on tangible returns and long-term value. They need to keep proving it.
And that wraps up our deep dive into the latest CIO survey. What really stands out, I think, is that nuanced picture. You've got this cautious near-term view, very selective spending, but underneath there's still this robust long-term commitment to the big strategic plays like AI and cloud.
Indeed, it reinforces that even with macro headwinds blowing, those fundamental tech trends are strong. It really boils down to figuring out where that essential spending is actually going and really understanding the ROI story driving the innovation.
Exactly. Well, thank you for joining us for this deep dive. We hope this analysis gives you some valuable nuggets as you navigate the markets, maybe something to consider. In this landscape of tempered budgets but high AI hopes, where are the overlooked opportunities for truly defensible growth? Something to think about. We'll be back soon with more critical insights.